please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Counter bids. But there goes the bell, and it's a good 0.5% higher. 10,180 almost is where the Nifty started. The Sensex started 33,190, and that's a 200-point gain almost. A 0.6 up on the Sensex. In fact, it's all guns blazing. The mid-caps as well are up 3/4 of a percentage point. And the Bank Nifty, as our experts were telling us, is likely to be the place where the gains will be highest. And that's up about, again, 3/4 of a percent. So it's starting with 5 stocks in the green for 1 in the red. Metals are leading the charge, but banks are not far behind. So Vedanta, Tata Steel, SBI, Yes Bank, the top 4 gainers are all up 1 to 2%. But then there are a bunch of stocks. I wouldn't be surprised if it's a 50 on 50. Okay, no. It's a 45 on 50 as far as gainers are concerned. It's Wipro. I mean, some of the IT stocks and evergreen stocks who are not in the limelight today. Aisha, M&M, HULZ, which anyway did not see too much of cuts, are the ones that are mildly, very mildly in the red. I mean, 0.1, 0.3. But otherwise, it's a sea of green. What a pleasant sight.
Oh, yes, it is after a long time, right? The mid-cap index as well is up about 150 points, looking pretty good there. The market breadth is strong, 5:1 in favor of the advances. We haven't seen that in a while, so let's soak that in. In terms of individual stocks, the BEML is a stock that Anuj was talking about in, in the top 10. It's up almost about 3% right now and picking up some more pace as we speak. Ashoka Buildcon is the other one that's been in the news for a lot of order wins. So Ashoka Buildcon is up 2.5% right now. A lot of these rice stocks have been doing well. So something like a KRBL and LT Foods, all these stocks up about 2 to 5% and volumes picking up there. A lot of stocks in the mid-cap IT space hitting 52-week highs today. So KPIT Technologies is a fresh 52-week high. Some trading interest is back in the PSU banking space, maybe short covering there. Canara Bank, United Bank of India, all in the green, up about 2%. IDBI Bank is up 3.5%. Andhra, Allahabad are also up about 2.5% or so. Max Financial is also in focus. So there is a board meeting by the company later today, so keep an eye out on that. That's the list of gainers. By the way, now the market is picking up some more pace, so more than 200 points higher on the Sensex. On the downside, though, hardly any stocks to talk about in the red. But overall, good opening, Anuj.
Good opening, and you know what? It may not work out that every time the market gives you a gap up, it will be sold into. Today could be a day of real short covering because there are so many shorts in the system over the last few days, and this could be the market's way of just trying to defend the 200-day moving average again. I mean, as we discussed, the stock of the morning really is BEML. That's up about 4% now, and big volumes on that one. And PSU banks are doing well. IDBI, Bank of India, Allahabad Bank, these stocks are up, but the market's putting on some more. Only problem, we are opening at 5:1 on advanced decline. So sometimes from that point, the mid-cap cool off a bit, but will be interesting to see. Right now, the index is up 1%. Ashwani, your thoughts on market opening and any interesting stock for you?
See, I think we have turned to have a decent pullback rally. Like I mentioned, 10,400, 450. So there will be lots of short covering today, particularly in these PSU banks. So early morning, what we have bought is Canara Bank, BOB, things like Tata Steel, etc. These are the kind of high beta type of stocks where shorts are generally trapped. So my sense is that today should be a good day, and it's time people bought into this gap up, because as the bears figure out that it's not coming off, I think more and more participation is likely to come in.
Okay, Phil, Sudarshan, have you started buying something? Would you buy the gap up?
Well, yes, that was the idea, to buy the gap up.
Yes.
So we are long in the Nifty, and we are also long, I mean, I would suggest buying Bajaj Finserv and HDFC Bank as a day trade. If they close strong, carry them for tomorrow.
Okay. Bajaj Finserv was already in Mitesh's list in the morning. So Mitesh, what else?
Apart from that, Lata, I think L&T is the first stock which has come on my radar. So I spoke about that in the morning, but that still looks good to me.
Okay. Ashwani, what's the big call for the day then?
I think banks will see very strong short covering, because yesterday also they couldn't move higher. So that's where, the shorts are hiding, and chances are they'll get a good hiding today.
Okay, by the way, IT stocks also looking pretty good today. Of course, not topping the charts, but still inching upwards. HCL Tech, TCS, etc., all looking pretty good. Good opening for the market. Thanks, gentlemen, for joining us and taking us through your views and individual stock ideas. Let's invite our market master now, Saurabh Mukherjee of Ambit Capital, joins in to discuss the market move and what we can expect so far, henceforth rather. Saurabh, hi, good morning, and thanks for joining in. What's the sense you're getting? It's not been a great start to the year. Of course, we've underperformed most emerging markets. Do you think it's our own domestic issues that are dragging us down?
I don't think the economy actually is in trouble. I think we've been discussing for the last 3 or 4 months on your channel. The economy is recovering quite nicely. I think what happened was valuations ran away into a sort of surreal place, especially the first 15-20 days of January. It was quite unbelievable to watch how the market went through the roof. So a degree of sobering, a degree of moderation was required in valuations. We've had some of that, and I remember a whole bunch of FII meetings early in January where they simply refused to buy Indian stocks because they thought the valuations were outrageous. So now that valuations have become a little bit more sensible, I still think the market's 10-15% overvalued, but at least valuations are a little bit more sensible than they were back in January. I think we'll see some degree of FII buying. The economy is in good shape. Valuations are still, I think, a little too high, but slightly more realistic than we were in the last 15 days of January, which was quite unbelievable to watch actually.
Okay, Saurabh, good morning. So, do you reckon that we are putting behind the correction? I mean, you always can't time the market, but broadly, somewhere around 10,000 should be the bottom for the market?
I'm not so sure. So as you're rightly saying, I've got no real view on the short-term movement of the market. I've got no ability at all to time the market. But my view is we're still 10-15% overdone. So if you ask me, is Sensex 33,000 fair value? I would say Sensex 30,000 is where we should be now. Whether Sensex 30,000 will come next month or next year is anybody's guess. But I think we're still a little too rich on valuations. And if you ask me what could be a trigger for the market continuing to see weakness through the summer, I would say it's liquidity. I think it's reasonably clear that whether it's in our banking system, in the bond market or in the stock market, liquidity clearly is much tighter now than it was 3, 4, 5 months ago, and that's leading to pressure on the system. We've seen what's happened in the bond market in the last 6, 7 months, and my reckoning is as long as system liquidity stays tight, I think we will have pressure on the stock market, even with earnings picking up, even with the economy clearly picking up.
Okay. Good morning, Saurabh. Good to have you with us. Well, therefore, I guess stock selection will be very important since you are going to have maybe these political disturbances putting a roof to the market. I'll discuss what can be the roof in a minute, but what will your sector preference be now?
So you're clearly looking to play what looks like a pretty healthy economic recovery, and therefore sectors such as metals and mining, which are a natural play on a recovery, I think should do well, especially if you continue to get global prices of metals rising. Second sector I would look at is the CASA funded banks. As bond markets tighten, as bond yields rise, short-term money markets rates also rise. The NBFCs and HFCs, I think, will lose ground to the banks, the CASA-funded banks. So the better quality CASA-funded bank franchises, I think, will become very attractive plays on what looks like an economic recovery. The third area would be in the 6, 7, 8 month run up to general elections. I think rural India will do well. It's reasonably clear now. The government said it several times. They will spend a great deal of money on rural India in the next 7, 8 months. I think somewhere around 2 trillion rupees will probably get spent on food subsidies in FY19, and that should give rural linked stocks a nice fillip. So those are the three sort of tactical plays I would look at. But beyond that, classic consumer discretionary franchises will continue to do well in our country. I know valuations are steep there, but on legendary franchises with great ROCs, I would continue to stay invested there.
Okay, so those are the sectors. But just coming back to that point you made earlier, Saurabh, about 30,000 being fair value for the Sensex. What phase of the bull market do you think we are in right now? I mean, is this a mature phase, or is this still just a blip in the nascent phase of the bull run?
I think in the first 15-20 days of January, it looked like we were in the sort of final blaze, final 6 to 12 month blaze of the bull market, where the sort of roof gets blown away on valuations and people go berserk. But I guess the liquidity tightening has brought a degree of soberation. My reckoning still is that I don't think we're going to suddenly enter a big bear market. My reckoning still is we're in the final phases of what looks like a pretty healthy bull market, even to me. So whilst I do believe the market's 10% overvalued, I do believe that there is overall underlying positive trend to the market, which should last for another year, perhaps a couple of years. And your main driver there is a robust economic recovery. Yes, the recovery is factored into the stock market, but it's very rare in our country. It's very rare in our country for the stock market to go into a bear phase when GDP growth is trending up. And I think the GDP growth trend up, I think, is central to the bull market continuing. And to the extent that on the back of the GST rollback, the further farm subsidies this year, the GDP growth trend is well established. I think that will lend the market a lot of support, short-term overvaluation notwithstanding.
Okay, by the way, the market is at the high point now, so 10,190 there about. 24,380 on the Bank Nifty, up about 1%. JSPL actually has moved to low point of the day, which is interesting because it had a big rally yesterday, and the stock is in F&O ban as well. So that one actually is now trending lower, so has moved to the low point. But Saurabh, last year was, big one for consumption, discretionary consumption. Autos in particular had a secular rally. We have seen that getting punctured a bit, especially big names like Maruti and TVS Motor, though Ashok Leyland is still doing well. Your thoughts on the entire auto pack?
I think we need to draw a distinction between auto and auto ancillary. In a good economic recovery, healthy economic recovery, I don't see any reason for the auto OEMs to suffer too much. I think their volume growth numbers will stay very punchy. I think auto ancillary, though, is headed for a much tougher ride. As inflation goes up, as both commodity price inflation and generalized CPI inflation goes up, I think auto ancillaries really don't have the pricing power, never did, probably never will. Auto ancillaries simply don't have the pricing power to protect their margins. And I think that is something that will become a fairly prominent feature of earnings in FY19. I think operating margin pressure on small and mid caps generally, and auto ancillary specifically, I think will become more entrenched in FY19. So I think that the sector will sort of bifurcate, where OEMs will continue having a decent run, especially on volume growth and earnings, whereas ancillaries, I think, are headed for choppier waters.
Okay, you also track, the politics of the markets very closely. Are you worried about what's been happening across the political landscape, and could that sort of create much more jitters in our market as we head into 2019?
So it's, I think, one of the sort of most interesting facets about working in India. There's this sort of enormous obsession about how the stock market and politics are linked. Nothing that I've seen about India's history or the 10 years that I've spent in the country suggests to me there's any profound link between the stock market and politics, really. I know we sort of obsess about it endlessly, and every assembly election and obviously general elections, there's feverish speculation on what will happen to the government and how it will bear down on the market. I'm not so sure there's actually any fundamental link. And hence, if the market comes off this year, if the market comes off nicely this year on the back of political developments as the exit polling season for the general elections begins in the winter, I would see that as a buying opportunity. I'm not really in that school which tends to link political results with the stock market. I'm aware other investors do, and if investors overreact to political developments, I would see that as a buying opportunity as the year progresses.
Yes, we had a couple of days back, Ruchir Sharma saying much the same, that politics is noise and there is an inner economic momentum in the country. Okay, Saurabh, two external facing sectors. You touched upon metals, but for the last 3 months, our commodities editor has been telling us that metals are ruling at 3-month lows globally. And secondly, IT. I didn't hear you mention that word. So
look, we plugged IT as as enthusiastically as we could through the last 3 months of calendar 17. I still continue to see the sector as having more juice left in it. I think our currency looks likely to slide quite meaningfully as inflation picks up through the summer, as we stoke consumption without really fueling investment. I think the Indian currency looks overvalued, and over and above that, the American economy looks likely to continue being in fine fettle, especially if Trump's stimulus comes through. So both as a play on a weakening rupee and as a play on a healthy economic recovery in the West, I think IT makes sense. I would focus on the large cap IT stocks. I think even now, after the 3-4 month rally in IT stocks, I think there is still value in the marquee IT franchises in our country. I think the selling got wildly overdone. Some of the large cap pharma stocks, I think there's value in some of the large cap pharma stocks. I think the pessimism again got overdone there. I think some of the bigger pharma names pulled back 40-50% last year. It was quite staggering to watch, actually. So I would have 1 or 2 large cap IT stocks, 1 or 2 pharma stocks in my portfolio to give that portfolio stability in what looks likely to be a choppy year from a market perspective, and then play the economic recovery with a degree of conviction, because if there's one thing you can bank upon in the next 12 months, it's that the Indian economy is headed upwards.
Okay, well, on that very optimistic
positive
note, Saurabh, thank you for joining us, and we will touch base with you once again. We have, of course, so many political developments. As and when they keep happening, we'll invite you on our show. But for now, the market is looking pretty good, you'd have to say. So 230 points up on the Sensex. The Nifty is holding pretty above the 10,180 mark, seeing so much green after a while, soothing to the eyes. But on to a big CNBC TV18 exclusive. Lata caught up with Ashish Gupta of Credit Suisse from the sidelines of their conference. She began by asking him what he made of the Reserve Bank's February 12th circular on the new NPA norms. Here's a slice of that conversation.
The circular actually accelerates the process of NPA recognition. We have now known for some time that the impaired assets of Indian banks are much higher than the reported NPA numbers. As per our estimates, the impaired assets are closer to 16% of loans compared to the last reported NPA numbers, which are closer to 10% of loans. And this incremental 4 to 5% of loans, most of which is actually sitting either in the restructured bucket or SDR or S4A, post this recent circular of RBI will get recognized as NPA more quickly. A large amount of it actually might precipitate on bank balance sheet as early as next couple of quarters.
Okay, but 10 to 16% is a large increase. NPAs can rise by 60%, you think?
See, all of it won't immediately move to NPA, and also RBI has still provided a window for banks to work on resolution plans of these assets. Additionally, another important consideration we have to keep in mind is the first list of RBI, the first 12 cases, their 270-day period ends around April. And you should expect to see resolution of those assets, and hopefully those assets or the large share of those assets which are 3 to 4% of loans for some of the banks will start moving out of the NPA bucket, right? So there will be inflow from this 5% of loans, and there will be some outflow on account of some of the earlier NCLT cases getting resolved.
Okay. Well, how would you describe this circular itself? Unavoidable, admirable, last of the bad news?
So, I think it is much needed, right? Because as a regulator, RBI was clearly feeling the pressure that now with over 4 years or 5 years where some of these forbearances had been in place, it had not helped the resolution process. And given whatever feedback one is receiving from the first stage of NCLT cases, the resolution process has been much better. The same banks, if you see the various steel cases as well, they've been willing to take haircuts varying between 30% to as high as 70-75%. So I think the regulator clearly felt that the decision making under the IBC code was superior to some of the decision making that was happening in the JLF forums. And this is perhaps the reason it decided to accelerate and move forward with this circular.
Okay, fine, fair enough. Let me come to more pleasant topics. We've had a lot of small finance banks getting listed. One of them is IPO underway and will get listed. Is that a space you would look for buys at all? The small guys, all the AUs and Bandhans and Equitas, that variety.
Sure. Again, without naming specific banks, what I would like to highlight is that since now nearly 3 years since RBI started granting a couple of new bank licenses and some of the small bank licenses, we have seen 6 companies converting to banks. There have been microfinance companies, infrastructure lenders, some NBFCs converting to banks. And actually, the success of all these has been a mixed bag. Some of these guys have very successfully transformed into a bank by broad-basing both the asset as well as the liability side of the balance sheet. Some of them have not been as successful both on the loan book side as well as broad-basing the funding profile. I think within this lot, if we ignore the valuations for the moment, investors should look for banks that have been able to build a good deposit franchise as a bank. And secondly, on the loan side, those that have been able to get into higher yield loan segments.
NBFCs, now that rates have risen, yields have risen at least, is there anything in that space you like, anything which can take advantage of that big report you wrote of fintech? How many of them look like good candidates for a fintech revolution?
Sure. Again, without naming names, I would kind of highlight 2 broad structural trends that are still favoring NBFCs. One is that loan demand in India is picking up, and clearly the aggregate banking sector is not in a financial position to be able to cater to all this loan demand. So there will be enough demand of credit for NBFCs to be able to grow at a good pace. Historically, though, whenever we have had rising rates, NBFCs as a stock have not done well. But there is a large difference now. Banks have moved to an MCLR regime. And what that means is that bank lending rates start moving up even as incremental deposit rates start moving up, right? And if you see some of the largest banks, just in the past month, they have raised MCLR by 20 basis points, and that provides NBFCs with much better pricing power so early in the cycle compared to historically. So I think this time around, the pressure on NBFC margins may not be as sharp as earlier cycles.
All right, that's the view coming in from Credit Suisse. Let's take a short break on that note.
Before that, just a bit of a word on the market, because it's just slipping a bit on the banks front. Especially if you take a look at a stock like PNB. I mean, if you see the intraday chart of that one, that's not the Nifty. Nifty is still holding into this zone, but Bank Nifty, a couple of these PSU banks are seeing a bit of a decline from the high point. and that's visible on the Bank Nifty as well, especially on the futures. From the high point, there's just been a bit of a tiny bit of a slip.
Oh, absolutely. You know, one pocket is looking very good this morning, and that is the entire retail space. So whether it's V-Mart retail, it's up 5%, future retail, future lifestyle, all these stocks up anywhere between about 3 to 6% and volumes piling up there. Let's do one thing. Let's take a break.